Okay, let's just say it. The stock market can feel super intimidating, right? But what if I told you it's also one of the most powerful tools you have for building actual real wealth? In the next few minutes, we're going to break down exactly what it is, how you can get started, and this is the most important part, how to do it without making a mess of things. Let's dive in. So let's just tackle the biggest myth right out of the gate. You know that picture in your head? The one with the fancy suit, the Wall Street office? The idea that you need to be rich to even think about investing. For a long time, that might have felt kind of true. But today, that whole idea has been completely blown up. I mean, seriously, the single biggest barrier, thinking you need thousands of dollars just to get in the game, is gone. It's history. The only thing standing between you and becoming an investor is a little bit of know-how. And hey, that's exactly what we're going to cover right now. This isn't one of those things you should put on a someday list. The tools are right there on your phone, the minimums are basically zero, and the opportunity is right here, right now. Let's get you the knowledge you need to feel good about taking that very first step. All right, so where do we even begin? Let's start with the big one. What in the world is the stock market? It sounds so complicated, but I promise you, the main idea behind it is actually incredibly simple. Okay, picture this. Your friend starts a lemonade stand and needs some cash for lemons and a cool sign. You give him $10 in exchange for 10% of the business. That little 10% stake? That's a stock. Now just scale that up. Companies like Apple and Tesla do the exact same thing, selling tiny little pieces of ownership, we call them shares, to regular people like you and me. And the stock market, that's just the big marketplace where all that buying and selling happens. Simple as that. So how does owning that tiny piece of a company actually put money in your pocket? Well, there are two main ways. First up is capital appreciation. That just means you buy a share for, say, $150, the company does well, and now it's worth $200. Boom, you made $50. The second way is with dividends. Some companies will literally share a slice of their profits directly with you, because hey, you're one of the owners. But here is where the real magic happens. It's a concept that Albert Einstein supposedly called the eighth wonder of the world. It's called compounding. This is the part where your investments start earning their own money. It's like a snowball rolling downhill. Your money starts making money, which then makes even more money all by itself. So what does that look like in real life? Look at this number. If you just invested $200 a month, that's it. Starting at age 22, based on how the market has performed historically, you could have over $700,000 by the time you're 62. And get this, the craziest part, you only put in about 96 grand of your own money. All the rest, that's just the magic of your money working for you over time. Okay, I think we can all agree the power of compounding is pretty mind-blowing. But with thousands of companies out there, what in the world should a beginner actually buy? This is the exact question that makes most people just freeze up. So let's make it simple. You've basically got two main choices. On one hand, you could try to pick individual stocks. This is like betting all your money on one single company to be a superstar. It's high risk, takes a ton of research, and honestly, it's like sitting down at a poker table with a bunch of pros. Or you can buy something called an index fund. With an index fund, you buy one single thing that holds tiny pieces of hundreds of different companies all at once. You're not betting on one horse to win the race. You're betting on the entire U.S. economy to grow over the long haul. And hey, you really don't have to take my word for it. The most famous investor in the world, Warren Buffett, has said over and over again that for most people, he even said this is the plan for his own family's inheritance, a simple, super low-cost S&P 500 index fund is the absolute best way to go. So what do these things actually look like? Well, here are three of the most popular low-cost index fund ETFs out there. Now, ETF just stands for Exchange Traded Fund. The easiest way to think about it is like a basket of stocks that you can buy or sell just like you would a single stock. VOO and SPY both track the S&P 500, so you get a piece of the 500 biggest companies in the US. VTI is even broader. It's like buying the entire US stock market. For a beginner, starting with one of these is a fantastic and much safer strategy. All right, so you know the what and you know the why. Let's talk about the how. How do you actually open an account and buy one of these things? You're probably going to be surprised at just how ridiculously easy it is. It's really just a simple 5-step process. First, pick a brokerage. Companies like Fidelity or Charles Schwab are amazing, super reputable choices for beginners. Second, you just sign up on their app or website. It seriously takes maybe 15 minutes. Third, you choose an account type. A Roth IRA is fantastic for retirement savings, and a regular brokerage account is great for general investing. Fourth, you link your bank account and transfer some money over. You can start with just $50. And finally, you search for something like VOO and you tap buy. That's it. Congratulations, you are officially an investor. Now, knowing what to do is half the battle, but knowing what not to do, that's the other half, and it's just as important. So let's go over the common traps that trip up new investors so you can just sidestep them completely. This is the big one. Everybody thinks, oh, I'll just wait for the market to crash and then I'll buy in. Let me tell you, that is a losing game. People have run the numbers on this. If you missed just the 10 best days in the stock market over the last 20 years, your total returns would be cut in half. The winning move is just being consistent. Invest the same amount of money on a regular schedule, no matter what the news says. It's called dollar cost averaging, and it just works. The market is going to go down. It's not an if, it's a when. It's a totally normal part of how this works. And when it happens, every bone in your body is going to scream, sell, get out before it gets worse. That is almost always the worst possible thing you can do. It turns a temporary dip into a permanent loss, and you'll probably miss the recovery that always follows. And this chart right here shows you exactly why you need to hold on. Just look at any big market drop in history, from the 2008 financial crisis to that scary fast drop in 2020. They all felt like the end of the world at the time. But every single time, the market has not only bounced back, it has gone on to reach brand new all-time highs. The people who just stayed put didn't just get their money back, they ended up way, way ahead. Okay, here are a few other quick traps to avoid. First, never, ever invest your emergency fund. That money needs to stay in cash, safe and sound. Second, don't chase after the latest hot meme stock. That's not investing, it's gambling. And third, and this is a big one, please do not wait until you think you have enough money to start. Building the habit is way more important than the amount you start with. We've covered a ton of ground here, so let's pull all of this out of the worlds of theory and into a simple, concrete action plan that you can literally start this week. This is your 5-day launch sequence. Day 1, just open the account. That's a huge win. Day 2, transfer a little bit of money to make it real. Day 3, pull the trigger, make that first purchase, and feel what it's like to be an owner. Day 4, put it on autopilot, set up those automatic contributions. And Day 5, download a tool to watch it grow. It's so motivating. In less than a week, you can go from zero to being a disciplined investor with a real plan. So there you have it. You now have the blueprint. You seriously know more than most people about how to start building wealth for the long term. The knowledge is yours, the tools are ready and waiting, and the path is clear. The only question left is the one right there on your screen. So, what's your first move going to be?